Good morning. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. Of course, we take this opportunity to also welcome those who join us on the heritage.org website today and in the future. We would ask everyone here in the house if you'll be so kind to see that cell phones have been turned off. It's always appreciated for those recording the program. And of course, we will post our event on the Heritage homepage for your future reference, and our internet viewers are always welcome to send questions or comments at any time, simply emailing speaker@heritage.org. Hosting our program today is David Burton, who serves as Senior Fellow in Economic Policy in our Institute for Economic Freedom and Opportunity. He focuses on tax matters, security law, entitlements, and regulatory and administrative law issues. He served as general counsel at the National Small Business Association for 2 years prior to joining Heritage. He previously was a chief financial officer and general counsel of the Alliance for Retirement Prosperity, a conservative alternative to AARP. For 15 years, he was a partner at the Argus Group, a Virginia-based public policy and government relations firm. His financial and tax career includes posts as Vice President for Finance and General Counsel of the New England Machinery, as well as manager of the U.S. Chamber of Commerce's Tax Policy Center. Please join me in welcoming David Burton. David? Thanks.
Thank you for being with us this morning. Our topic today is whatever happened to promoting small business capital formation. Entrepreneurship matters. It's the source of most new net job creation in the United States. It's the source of much of the dynamism and innovation in the economy, and it's a major source of economic growth. Now, small and startup companies cannot afford to access the public capital markets. Accessing the public capital markets involves millions of dollars on lawyers and accountants, and it's an insurmountable bar for most new companies. Instead, they use the private capital markets, usually Regulation D. Regulation D accounts for almost $1 trillion in new capital raised annually, although only a small portion of that is raised by small and startup firms. Now, in April of 2012, in a rare bipartisan consensus, the Jobs Act was passed with large bipartisan majorities and signed by President Obama. It was widely recognized that the federal and state securities laws are a major impediment to capital formation by entrepreneurs, and that it was unduly difficult for startups to raise the money they needed to launch and for young, emerging growth companies to raise the capital they needed to grow. The Jobs Act is an extremely important piece of legislation. It's the first deregulatory piece of legislation in this arena for several decades. Now today, more than 2 years later, we're still waiting for the Securities and Exchange Commission to adopt regulations allowing crowdfunding and Regulation A+ to move forward. And in addition, the SEC has proposed new rules governing Regulation D that, if adopted, would impose new significant barriers on those trying to raise capital using Regulation D. SEC Commissioner Dan Gallagher has graciously agreed to join us to discuss these very important and generally underappreciated issues. It's my hope that his remarks today will help bring these issues greater attention among conservatives, the small business community, and the broader public. Dan Gallagher has been an SEC Commissioner since 2011. He also served on the SEC staff as counsel to Commissioner Atkins and later as counsel to SEC Chairman Chris Cox. He was Deputy Director of the SEC Division of Trading and Markets in 2008 during the financial crisis, where he played a key role in fashioning the SEC's response. He later became acting director of that division. Prior to serving at the SEC, Commissioner Gallagher was general counsel and senior vice president of Fiserv Securities, where he was responsible for managing all of the firm's legal and regulatory matters. He began his career in private practice representing broker-dealers. Commissioner Gallagher earned his JD, magna cum laude, from Catholic University, and he graduated from Georgetown University with a BA in English. given that he now works in the securities law field, it might have been better served if he'd studied Greek. As commissioner, he's focused on reforming equity and fixed income markets, meeting the capital formation needs of small and emerging growth companies, and reducing the outsized role given the credit rating agencies and proxy advisor firms. I would like to add that Commissioner Gallagher has been a voice of reason at the SEC. He understands that the securities laws of the United States badly need reform, and that a key part of the SEC mission should be promoting rather than impeding capital formation. I'm confident that the ideas he'll share with us today are going to be well thought out and constitute a roadmap for constructive reform. I'd like to thank him for being here today and for his work in a sometimes difficult and frustrating environment to improve the regulatory environment for small businesses. Please join me in welcoming Commissioner Gallagher.
Well, thank you, David, for that very kind introduction. I actually did study Latin, but sometimes you're right, it's like a different alphabet. The securities law, so Greek might have been more helpful. I appreciate all that the Heritage Foundation in general, and David in particular, are doing to focus attention on key issues in the capital markets, and I'm honored to have the opportunity to be here today. And as you might guess, if you've ever heard an SEC staffer or commissioner speak, I have to tell you that the views I express today are my own and don't necessarily represent those of the commission or any specific commissioner. And with me, that usually becomes obvious pretty quickly. It's almost cliche now for political figures of all stripes to state that small business is the lifeblood of our economy and the primary engine of economic growth and job creation in this country. But it's a truth worth repeating. And in this era of partisan polarization, it's good to have some common ground, at least on a conceptual level. But small business has a big collective action problem here in Washington, where it's regularly and systematically underrepresented in the legislative and regulatory process. Small business owners are focused on making ends meet and growing their businesses, not on hiring high-priced lobbyists to influence policy. Big business and unions, by contrast, can afford to hire lobbyists to develop relationships with politicians and regulators, which is the way business in the U.S. increasingly gets done. As an SEC commissioner, I believe that this issue warrants the agency's highest level of priority. And as the son of two longtime small business owners, I take this issue very personally. I'd like to think that the SEC, with its mandate to promote efficiency, competition, and capital formation, would be immune from, or at least could rise above, these trends. But sadly, we at the SEC are not doing nearly enough to ensure that small businesses have the access to capital that they need to grow. We layer on rule after rule until it becomes prohibitively expensive to access the public capital markets. Only rarely do we remove any of our rules, even after they have long since ceased to serve their purpose or have become obsolete or worse. And although we've made significant progress in expanding our economic analysis of new rules and rule amendments, we almost never consider how heavily the weight of the entire corpus of rules bears down on registrants. Of course, not all this is the SEC's fault. Much of the ever-growing rulebook is a direct result of congressional mandates. But the Commission has discretion, along with exemptive authority, to make these mandates less onerous. Unfortunately, its track record for doing so is mixed. Moreover, on the rare occasions when Congress attempts to help us streamline our rules, the SEC's response is rarely enthusiastic. When the Jobs Act undertook a much-needed liberalization of certain private offerings under Rule 506, the Commission infamously responded with a proposed rule that seeks to not only undo some of the benefits achieved in that bipartisan statute, but also to impose new burdens on all Reg D transactions. Given these negative trends for capital formation in general, it's no surprise that issues specific to small business capital formation too often remain on the proverbial back burner. This lack of attention doesn't just harm small businesses, it also harms investors and the public at large. Companies are understandably hesitant to incur the ever-increasing burdens of going public. Investors that don't have the resources to buy a venture capital fund then don't get the opportunity to profit from the potentially explosive growth of early-stage companies. Moreover, when the burdens of going public push venture capital funds to exit their investments through M&A activity rather than an IPO, the public at large loses out on the significant job growth that normally occurs after an IPO. Thankfully, the SEC has the ability to pursue meaningful reforms, both substantive and procedural, that could significantly improve small business capital formation. Hopefully, someday, we actually will, unprompted by Congress. In pursuing these reforms, the SEC must think about its capital formation regime on a big picture level. For example, we need to ask whether our system of registration requirements and exemptions therefrom, as it has evolved over the past 8 decades, provides companies with an end-to-end solution for accessing the capital markets. And by end-to-end, I mean that companies at any point in their lifespan should be able to access the capital markets. The alternative is to leave growing companies entirely dependent on the vagaries of bank funding. Just ask Europe how that's working out. We also need to ensure that the rules that apply to small businesses are easily understandable, even without a law degree or expensive lawyers or Greek translation. At least for small businesses, our focus should be on aligning our exemptions with the ways in which companies actually raise capital, rather than shoehorning capital raising techniques into existing complicated exemptions. I also believe that a fully robust capital markets ecosystem for small companies should encompass both the private and the public markets. Our rules should facilitate access to both equally, as this redundancy can protect against market failures. And what does this mean in practice? To start, we need a robust set of private offering exemptions under Reg D that allow a company to access our markets while still remaining private as long as it so desires. But we also need the parallel ability for a company to access the public markets at the time and through the means of its choosing. For example, crowdfunding, Reg A or Reg A plus offerings, IPOs with emerging growth scaling, including smaller reporting company scaling if applicable. And finally, IPOs without any scaling or registration under Section 12G of the Exchange Act. We need to involve the entire Commission staff in promoting small business capital formation. This isn't just a matter for our Division of Corporation Finance. Our Division of Trading and Markets, for example, has a role to play. While CorpFin is focusing on the methods by which a growing company can seek to raise capital from public or private markets, Trading and Markets should be thinking about how to facilitate secondary market liquidity for that company's shares. This is not a matter of putting the cart before the horse. Secondary market liquidity can make or break a primary offering, as we are learning in our Reg A plus rulemaking. And Trading and Markets must be constantly evaluating the application of trading and registration rules to small entities, as they recently did with the long-awaited and well-received, certainly by yours truly, M&A Brokers No Action Letter. And our Office of Chief Accountant, in supervising the FASB and PCAOB, needs to ensure that their respective accounting and auditing standards are scaled or scalable for smaller businesses. We need to promote an infrastructure of intermediaries, such as investment banks or accounting firms, with sufficient economic incentives to specialize in smaller companies. And our Division of Enforcement must also play its part. The SEC should be focused on personal responsibility for individual wrongdoers, rather than corporate liability and the attendant shareholder penalties for amorphous misconduct. And similarly, we should ensure that we recognize that not every business failure is fraudulent. Entrepreneurs need to have the room to take risks, which means the room to fail. Without risk, there is no reward for investors. The good news is that we have many elements of this in place already. The bad news is that some of these elements are missing and some could be improved. So I'd like to discuss a number of near and medium-term fixes to some of our regulations that could help facilitate small business capital formation. The private securities markets have been an incredibly important part of small business capital formation over the past decade. And so, as you might guess, I am very hesitant to advocate any significant changes. However, looming over these markets is the threat of the Commission finalizing proposed Reg D rules to impose new and substantial burdens. As I noted in my dissenting statement for the proposed amendments to Reg D, certain aspects of the proposal actually could be acceptable. They could help the Commission gain useful data about the private markets, thereby facilitating a data-driven approach to oversight of those markets. But the majority of the proposal would do more harm than good, stifling the private markets while achieving no clear offsetting investor protection goals. Thus, I believe the most productive near-term step we could take in the Reg D markets today would be to simply withdraw the proposed rule. In the medium term, the Commission needs to do a deeper dive into Reg D to consider fundamental questions about who uses it and for what purposes. For example, 99% of capital raised under Reg D is pursuant to the Rule 506 exemption, even though 2/3 of those offerings are sufficiently small that they could have been done under either Rules 504 or 505. The simple reason for this is that Rule 506 offerings are blue sky exempt, while Rule 504 and 505 offerings are not. I believe we should consider broadening the blue sky exemption to help make the choice between types of Reg D offerings a meaningful one. Taking a closer look at this and a number of additional issues in our private offering rules could reduce regulatory frictions and improve private offerings. Finally, we need to look at the secondary market for private company shares, where innovation appears to have slowed. We need more facilities to improve trading among accredited investors in the private secondary market. We should also examine whether our resale rules are clear and whether expanded or additional safe harbors might be appropriate to facilitate those transactions. Switching gears now to the public markets, I'll start off small and work my way up. To begin, I believe that crowdfunding can play an important role in small business capital formation. A would-be entrepreneur far from Silicon Valley, with no contacts in established angel investor or venture capital communities, should be given a chance, through the wisdom of the crowd, to get funding for his or her idea. But unfortunately, the path forward for interstate equity crowdfunding isn't clear. While the initial crowdfunding bill introduced in the House of Representatives properly balanced the competing interests of investor protection and capital formation, the Senate version eventually included in the Jobs Act so skewed that balance that it threatens to rob crowdfunding of much of its potential. For example, the requirement that companies raising over $500,000 file audited financial statements is far too expensive for the amount of money being raised. If this were the only issue, perhaps we could find an easy way forward. But unfortunately, there are many other issues that commenters and others have identified that need to be addressed. I'm committed to finalizing our rulemaking in a workable fashion, and if that isn't possible, then the Commission should be loudly telling Congress that we need a legislative fix and that we need it now. I'm genuinely excited by the potential democratization of early-stage capital raising that crowdfunding promises. I'm just dismayed by the potentially unworkable nanny state construct of Title III of the Jobs Act. One last point on crowdfunding. Regardless of how we proceed, we need to make sure crowdfunding is fully integrated into our capital markets rather than treating it as a curiosity or consigning companies that make use of it to a dead end. In the meantime, we should finish implementing the Jobs Act robust reforms to Reg A and couple these reforms with the formation of venture exchanges. I've not been shy about expressing my belief that these two reforms, taken together, are potentially revolutionary. The Jobs Act breathed new life back into Reg A scaled registration and reporting regime for small issuances. Previously robust, Reg A fell out of favor after improvements to Rule 506 offerings, particularly the blue sky exemption, made them significantly more attractive. The Commission has proposed a robust set of rules to implement the Jobs Act provisions, including blue sky preemption for all offerees and for all purchasers in certain larger Reg A offerings. The resulting outpouring of anger from state regulators in general, and NASA in particular, was not unexpected. After all, state regulators have been protecting investors from investment opportunities that are too risky for decades. And I'm sure the Massachusetts residents who missed out on the offering of Apple Computer in 1980 because of their regulators' concerns about the risk know this all too well. But nonetheless, the state regulators' response to the Reg A Plus proposal was disappointing. I simply don't understand why a federal registration and review regime tailored for smaller companies but nonetheless comprehensive that doesn't divest the states of their enforcement authority should be viewed as representing a threat to investors. So I believe we should finalize Reg A Plus expeditiously as proposed, with only two clarifications. First, we should raise the cap on the maximum size of offerings from $50 million to $75 or $100 million. And second, forward lad, we should exempt shares issued pursuant to Reg A Plus from Section 12G of the Exchange Act. While I believe these steps would invigorate the primary issuance of small business securities under Reg A, attention also needs to be paid to the secondary trading of Reg A shares. Here, I've been calling for the creation of so-called venture exchanges, national exchanges with trading and listing rules tailored for smaller companies, including those engaging in issuances under Reg A. Shares traded on these exchanges would be exempt from state blue sky registration. The exchanges themselves would be exempted from the Commission's national market structure and unlisted trading privileges rules so as to concentrate liquidity in these venues. This should in turn bring market makers and analysts to these exchanges and their issuers, thereby recreating some of the ecosystem supportive of small companies that has been lost over the years. Other variables, for example, such as continuous trading versus periodic call auctions, tick sizes, and minimum capitalization would be left to each exchange to determine, with the aim of creating different, idiosyncratic venues that can compete with each other. I believe that these exchanges could have a transformative impact on small business capital raising. But given everything else on the SEC's plate, I'd like to engage in a little bit of crowdsourcing here. Specifically, I encourage all of you, as practitioners, academics, and interested parties, to refine this proposal through evaluating the legal and practical issues, and then to advocate for its inclusion in the SEC agenda. Now, we come at last to the traditional public markets. Companies of many sizes and at many different stages of development may go through an initial public offering. Our post-IPO disclosure regime needs to effectively address these differences amongst companies. Here, I believe we should make better use of the smaller reporting and emerging growth company distinctions. Whether to tailor disclosure requirements for these categories or to exempt them entirely should be a primary decision point for each new disclosure rule to be addressed with data and analysis. The Jobs Act was a floor, a directive from Congress to do more in this area, not a ceiling. In particular, I hope that as part of the Division of Corporation Finance's examination of disclosure effectiveness, or, as it used to be called, disclosure overload, Commission staff is examining which of our current disclosure rules could be scaled more effectively for smaller reporting and emerging growth companies. But even putting scaling aside, a reduction in the volume and cost of disclosure that benefits all companies will benefit smaller and emerging companies proportionally more, given the higher marginal cost to them of each dollar spent on compliance. I hope CorpFin staff is giving serious attention to simplifying disclosure through this project, rather than treating it as largely confirmatory of our existing disclosure regime. There's already a plethora of good ideas out there. We should move forward with them. In the medium term, I believe that we should reconsider the current thresholds for scaled disclosure and the amount of scaling that comes at each level. Currently, a smaller reporting company is defined as a company with up to $75 million in public float. But this definition doesn't align with commonly accepted market definitions. Having two tiers of scaling, for example, significant scaling for nano-cap companies of up to 50 million in capitalization, and then moderate scaling for micro-cap companies with a capitalization of between 50 and 300 million may be more appropriate. Finally, liquidity for secondary trading in small businesses should be re-examined. Secondary trading in small-cap stocks is a perennial problem, and the Commission should be paying more attention to this area. In particular, we could encourage microcap companies that are not reporting companies to commit voluntarily or as a condition of participation in a venture exchange or some other type of junior exchange tier to a periodic reporting regime. It could be the Reg A regime or some other tailored form of reporting. And this could result in better information reaching the market, which could encourage investment. I'm certainly open to other ideas, and I encourage you to weigh in on these issues. While all of the substantive changes are, I believe, important to pursue, I'm sure that there are other good ideas out there and that the list of ideas will evolve over time. So I believe we at the SEC also need to change our mindset and our procedures with the objective of institutionalizing an enhanced small business focus at the Commission. It's important for commissioners as well as senior staff based in Washington to get outside of the Beltway. While I'm on the road, I like to speak directly with businesses, and particularly small businesses. That takes some extra effort to arrange, but getting outside the Washington bubble is always eye-opening. I do this as often as I can, and I never come back to D.C. without new information and real-life stories from those who are actually working in the real economy. But there is the ages-old problem of getting the Commission to focus on these issues when there are so many statutory mandates and other initiatives competing for limited bandwidth. And so, I believe the SEC needs to create an Office of the Small Business Advocate reporting directly to the Commission. This office could be modeled on the Office of Investor Advocate created by the Dodd-Frank Act. And there's a natural parallel here, in that our staff perennially faces difficulty in receiving views from certain segments of the market that find it difficult and expensive to participate in the normal notice and comment rulemaking process. And those, of course, are retail investors and small businesses. Having a single point of contact for outreach to underrepresented groups who can then turn around and advocate their views to the staff and the Commission is critical. Finally, just as the Investor Advocate now runs the Investor Advisory Committee, the Small Business Advocate could take charge of the SEC's Advisory Committee on Small and Emerging Companies and the Government Business Forum, an incredibly important group that doesn't have the profile it deserves at the Commission. And we should also invigorate the process of considering small business issues in our rulemaking. The SEC has grown in leaps and bounds in its focus on economic analysis following several key losses at the D.C. Circuit for failure to give adequate consideration of the economic impacts of our rules. While the D.C. Circuit losses gave us an external impetus for reform, the reform the SEC undertook was in fact completely internal. We centralized the economic analysis function in our Division of Economic and Risk Analysis, crafted and adopted economic guidance, and enforced compliance with it internally in our rulemaking process. The results so far are encouraging, and we need to continue to improve our economic function at the Commission by ensuring that DERA has all the resources and Commission attention that it needs to be successful. But while compliance with our economic analysis mandate has thrived, compliance with our small business mandates has languished. The Paperwork Reduction Act, Small Business Regulatory Enforcement and Fairness Act, and the Regulatory Flexibility Act all require some form of analysis to be undertaken by the Commission when we promulgate rules. Yet, they are generally treated as afterthoughts on the so-called back end of the rulemaking process. I believe we should devote the kind of resources to these analyses that we do to economic analysis, not because we're being forced to, but because we should. It's the right thing to do. We already have the tools and statutory mandate to consider the impacts of our regulations on small businesses. We should use them. To assist us in that endeavor, we used to rely on a robust Office of Advocacy at the Small Business Administration to provide input on our rulemakings. While that gadfly's bite did sting at times, it served an incredibly useful purpose. But recently, the vigor of the SBA's review has been somewhat lacking. I understand that there may be some hesitancy by the SBA to review the rulemakings of an independent agency. But that review process is beneficial, and if it's not legally mandated, we should voluntarily commit to it. Our rules should be sufficiently robust to stand up to that analysis, and if they're not, then we have to work to make them so. Similarly, our engagement with the Office of Management and Budget should not be limited to routine Paperwork Reduction Act compliance. Executive Order 13563, administered by OMB's Office of Information and Regulatory Affairs, OIRA, contains many sound principles for reducing regulatory burdens, such as assessing the cumulative cost of regulations and conducting a retrospective analysis of existing rules. Executive Order 13579, in turn, states that independent agencies should comply with these principles and specifically directs independent agencies to develop and release to the public a plan for periodic review of existing significant regulations. We haven't done it. As you know, I don't shy away from fighting for the SEC's independence. But here, where the principles are bipartisan best practices, the SEC should commit to working with OIRA to achieve compliance. This is an ambitious agenda, but one worth pursuing. Small business capital formation is too important an issue for us to ignore. While the Commission has a busy rulemaking calendar, this is another of the so-called day job items, the core competencies of the Commission that we cannot afford to neglect. Thank you for having me here today, and I'd be happy to take some questions. I already know your questions for you. We'll start here. Okay, all right.
All right. So one of the concerns I've had is that our existing securities laws may, in effect, be detrimental to those regions of the country that do not have high concentrations of accredited investors. In essence, redlining. Have there been any studies that you're aware of, because I haven't been able to find them yet, that might be able to show that with regard to the Reg D filings and the 402 type private offerings, that they're concentrated more on the coasts and areas where there are high concentrations of wealth, and therefore depriving areas like Ohio, Michigan, and others of the growth opportunities for small and medium-sized businesses?
That's an excellent question. Unfortunately, I don't have the answer to it. I don't know. And if you find one, or David might know and can weigh in.
There is none that I know.
There is none.
Is that something that could be directed toward DERA to look at? Because it could provide a political motivation to both parties to seek a resolution to advance the causes on
Our Center for
crowdfunding
Data
and funding.
Analysis is working to try to develop information about that problem. So we are trying to do it, but the data limitations are an issue.
Because that should be part of your economic analysis.
Yeah, look, and I think you and I have discussed a flavor of this before, and I think it's worth now that we have our new chief economist in. Right at the time you and I were talking, we had Craig Lewis leaving, and now we have Flannery's in. So this is something I'm going to ask him about. I think the response we'll get, just so you know, is that Reg D with the proposal that's outstanding with its Trojan horse of let's get more information, brought with it a lot of burdens too.
Yep.
The Trojan horse could actually be useful, as I just said in the speech, but we should
Exactly.
bifurcate that and pursue it as opposed to, laying out the entirety of the burdens
I'm
that
just
were
thinking
proposed.
that this might provide you the data you need to go back to Congress
Yeah,
and seek the authority you
Yeah.
want, so that crowdfunding and Reg A.
it's a great idea for it, and we'll follow up. If anybody here finds anything even close, please send it to me. And in the meantime, I'll just point out that that's what Reg A, that's the beauty of Reg A Plus if we get it done the right way. It's not limited to accredited investors. It's democratized capital formation. It's allowing the guy in Ohio that works in a mill to buy into a local endeavor that he wants to.
It would also allow a location where a factory has moved and gone south or overseas for the workers to form an entity.
Yeah, that's a great point.
May I ask that people state who they're with and use the mic so that people watching on the internet can hear?
Yeah, I think we have
Hi, I'm Bob Karlstrom. I'm a consultant to the Association of Mature American Citizens, the conservative alternative to AARP2. This is our president, Dan Weber.
Nice to meet you.
The questions, it really relates to the advocacy comments that you made in terms of how responsive is the SEC, or are they getting information from, let's say, the House Small Business Committee, the Office of Small Business Advocate at SBA, from NFIB? And if so, perhaps you can comment on the receptivity to it. In fact, in AMAC, we've recently launched what we call AMAC Small Business Solutions, again aimed at people 50 plus who are forming their own companies or running companies as well. So we have a great interest in terms of what you're doing there.
Yeah. Well, I think, look, as a general matter, the commission and the staff are receptive to any and all comments as a general rule. Have I seen any sort of preferencing or special attention paid to small business commentary? No. And I think in the context of 100 mandated Dodd-Frank rules in particular, it's all too easy at the commission to say it's a statutory mandate. Congress would have thought about that. Congress should have done that filter for small business. So, for example, when I ask for an exemption, a de minimis exemption in the conflict minerals rule, to carve out private companies in the supply chain of this massively onerous burden, and I'm told, no, Congress knew how to give a de minimis. They did it elsewhere. They did it for the extractive resources rule in 1504, and they didn't do it here. And so there's cover, unfortunately, for the staff and the chairman in determining not to pay attention to small business issues. And it's because of these mandates. It's not right, but it's the way it is. And in the meantime, as I just laid out in the speech, Dodd-Frank created by statute an investor advocate and an investor advisory committee. The small business committee that we have is terrific, but it's voluntary. There's no statutory mandate that their reports go directly to Congress. Right? There's no real commission interaction with them unless we go seek it out. The reports are great. They called for venture exchanges well before I did. I stole their idea on that one, happy to say. So we need to do more. We need structurally, as I just said in the speech, to do more. And you guys should be loud about it. Everybody should. There's no reason why we get these politicians speaking out of one side of their mouth through the Jobs Act, all of them, all the way up the food chain on that statute, that small business is the engine of our economy, and then sticking it to small business through all of these mandates and rulemakings that just burden time and again. A great example, by the way, this is a recent Title IX rulemaking we just did at the SEC, which normally might not be relevant to you for credit rating agencies, where we just pumped out another 900-page final rule that will burden the rating agency industry, where in 2006, Congress told us we had to increase competition in the rating agency business, that the big three are acting as an oligopoly, and that's part of the reason why they're lazy and they're corrupt, right? Let's get the small entrants in there. Well, the small entrants aren't going to play when you burden them up to the point that they can't afford compliance. And the big three can, I'll tell you that much. So even in a space where the last Congress said do this, add competition, get these small rating agencies. There are a couple guys who are doing them out of their garage. Right? They couldn't get the NRSRO imprimatur from the commission, so Congress stepped in and said, we're going to come up with a new plan so that you can actually enter this market. We've now just loaded them up with burdens such I wouldn't be surprised if several of them didn't drop their registration. So a lot more needs to be done.
We do have one question from the internet, from a gentleman named Patrick Reardon in Fort Worth, Texas. The question is, does the enactment of the Jobs Act reflect the SEC's failure to be proactive during the Great Recession?
No, it reflects the SEC's inability to be proactive for the last 3 decades. If you look at, in particular, the removal and the ban on general solicitation, Title II of the Jobs Act, that's an idea that's kicked around the halls of CorpFin for literally 25 plus years. It was something we were discussing before the Jobs Act. It was something that Commissioner Paredes and I were pushing heavily on the chairman and the director of corporation finance to do. And Congress, rightfully predicting that we would never get it done, decided to make us do it. And even there, how simple as that was, remove the ban on general solicitation, you would think that that's something that could be done with a pen stroke or less. It took us over a year, and we decided to gum up the Reg D markets when we did that too. So it's just it's a sad time with respect to proactive efforts at the Commission to address these issues. But the spirit of the question is absolutely spot on. Almost everything that's done in the Jobs Act could have been done organically at the Commission had we focused attention on it. You're going to get the microphone here.
Bruce Merrifield. Bruce Merrifield. I spent many years in industry. I was Vice President of Technology for Occidental Petroleum. Spent 8 years in the Reagan administration as Undersecretary of Commerce for Technology and Economic Affairs.
That's great.
And then as Professor of Management and Entrepreneurship at the Wharton Business School. So I'm really...
Now I'm nervous about what you're going to ask. I'm intimidated right now, I'll confess.
Well, as Undersecretary, I had access to information that not very many people seem to see, but and the regulatory glue that you're focusing on is incredibly important. We've got to get that away for new startups. There's another factor there here, and it resulted from the Economic Recovery Tax Act, which reduced taxes $400 billion over the next 4 years. One tax was 10 times more important than any other. It's the capital gains tax.
Mm-hmm.
It was intended to help big companies renew themselves, and a few even did. But what unexpectedly happened was that it jump-started new small business and corporations from about 250,000 a year to 1 million a year. Over the next 30 years, we created 30 million new businesses, 90 million new jobs in those small businesses, and 87% of all household American wealth, consumer wealth. Your credits calls this the American miracle, but the important thing here is that, of course, it's stalled out now.
Right.
The
Right.
capital gains tax is kicked up and we're killed with this regulatory glue.
Right.
But it could be reactivated. In fact, I sent this information to Romney and suggested that he reduce the capital gains tax to 0. And about a week later, he announced he was going to do that. I don't know if you noticed that.
I did notice that, yeah. Good for you.
The important thing is that in 1965, the capital gains tax was about 25%. In 81, it was 40%. Then reduced to 20% in the Economic Recovery Tax Act. And that's what triggered this small business revolution,
Right.
which is unique in history. Nothing like that has ever happened before. And we can reactivate it. You see, when you raise those taxes from 25 to 40%, did tax revenues go up? Of course
No,
not.
of course
They
not.
went down.
Right,
And of course, when it was reduced to 20%, they exploded.
right.
They exploded,
Right.
you know, from 10 to 56 billion, something like that. So basically, that one factor. But the important understanding of this is that enabled you and me as entrepreneurs to use our own tax shelter money. There are trillions of dollars in latent tax shelter money not earning anything. But when my tax rate went from 40 to 20%, I could now take that money.
Sir, could you wrap up your question, please?
And the important thing about this is that it's my money, it's risk money, it's not tax dollar money.
Right.
But it's skin in the game, and
Yeah.
I'm gonna damn well be sure that I invest in something that's useful, and I'll knock myself out to make it happen. So, this is not venture capital type money. Venture capital, 2 or 3 out of 10 succeed, 2 or 3 fail, the rest are walking wounded.
Right.
They created the dot-com bubble, which 80% should never have been funded.
Right.
But this process opens up a new tax advantage source of capital, independent of banks, independent of
Right.
bureaucratic government agencies.
Right.
And we could do it tomorrow, and then by removing all regulatory problems for
right.
these new startups, only for small businesses. They don't need regulation.
Amen. And I think it's great. Now, blissfully, the commission has no role to play with respect to tax policy. So as a citizen, I say,
All you're gonna
amen, it's a good
reduce
point.
the capital gains to tax.
Well, but I think, I take from your point, even very simple measures can be transformational in nature. And, some of what I just talked about is a lot less simple than a quick tax code fix. Not that amending the tax code is ever simple, but the idea is. So thank you for that. Who do we have? Oh.
Yeah, Sarah Hanks from
Hey, Sarah.
Project. Hi. On the issue of venture exchanges and state law preemption of trading under 4A1, do you see a regulatory fix for that, or does it have to be a legislative fix?
Well, I think there is a regulatory fix. I think if we can fix it in Reg A, we can fix it in 4.1 and for the venture exchanges. So now it just would require boldness to do it. It'd be better in some ways if Congress did it, but I think this is an area where the Commission should feel sufficiently comfortable that bringing secondary market activity out of the OTC into the lit markets, that's a plus for investors and the markets.
So it would be just something as simple as defining everybody who's trading on those markets as qualified
I think
purchasers?
so. Hold on, let's be.
Hi, Kai Sisson with Town Hall. You mentioned how you like to get out of the Beltway and talk to business owners. Is there a story that you can tell us that's an example of the problems that small business owners are facing?
I'm trying to think which one sticks out the most. I was in an angel investing group in San Diego while the Jobs Act was being finalized. And I was convinced that crowdfunding was the biggest component of the Jobs Act at the time. It certainly was getting outsized attention. And that's where I was educated with respect to Reg A. Reg A was the biggest afterthought, I believe, of the Jobs Act. But I now personally believe, based on that meeting with a bunch of angel investors and hearing them talk, and this is why I specifically referenced in my speech how crowdfunding has to be an important stop on the capital formation chain. It can't be the dead end, right? If it's just going to be this side pocket that has nothing to do with the other evolution, the ecosystem that would end with an IPO, then there's a problem with it. I thought that's what it was intended to be. Listening to these investors, especially as they analyzed what the Senate was doing to the bill at that time, they said, well, no, all the action is if you can get Reg A correct. And so I came back and did a very deep dive on Reg A, thought more about the secondary market issues. And that's the kind of information. None of these folks, they're terrific and savvy folks, but they weren't going to be making the rounds with their lobbyists at the SEC anytime soon. So that, to me, might be the most pivotal piece. I've had other, from larger companies too, just amazing meetings on things like the pay ratio rulemaking and, just an understanding if you meet with the head of HR or COO of a Fortune 500 company on how their systems run, right? How literally technologically they can't comply with a rule that meets the statutory mandates for pay ratio. Then you can come back and meet with the staff better armed to say, this is crazy, right? We need to use exemptive authority here or there. You can make better arguments when you have the facts. It shouldn't be a book club. It shouldn't be folks sitting back thinking they know everything, because we don't. Back.
Good morning. My name is Todd McCracken. I'm with the National Small Business Association. Very pleased to hear your remarks this morning. It's very encouraging. A couple of points I'd like to make. One is when your fellow commissioners and other folks at the SEC mentioned that if Congress had wanted there to be some sort of special exemption or program for small companies, they would have created de minimis. Remind them that in fact Congress has created the Regulatory Flexibility Act, which specifically requires agencies to make different rulemakings if warranted for small companies.
That's right.
And so clearly Congress has thought of that and has acted in that regard.
Well, and Congress gave us exemptive authority in 1996.
Right.
More importantly, it's blanket authority.
But secondly, I think one of the things that could be really transformative in your proposal is the idea of a Office of Small Business Advocate, not just for the issues that you cite, but unforeseen issues for decades hence. Because as you correctly note, small companies, even though we do our best to try to represent them, going through SEC rulemakings isn't the first thing they do when they get up in the morning. And having somebody who really can focus on that and has the resources to bring them to the table in a proactive way
Right.
could be really transformative.
Right.
So we would love to advance that idea, and I'm curious what kind of reception you may have gotten either within the SEC or other outside groups to that idea.
And we'll find out when I get back. A couple blocks away. It'll probably already be over there by now. Look, again, I'd like to, when I speak publicly, and as I have for the last 3 years, talk about things that actually can happen and should happen, and that I and the Commission can have an impact on, not pie in the sky stuff. This shouldn't be partisan. This shouldn't be pie in the sky. This is good government. This is taking all of these bipartisan statements of the Jobs Act. Go look at the signing ceremony statement by the president, and then look at the reality on the ground at the Commission, how we treat small business issues, and there's a complete mismatch. Right? So this should be something we can do. And I do think the biggest problem, and I've given full speeches about this, with the agency right now is the agenda. And what most folks don't get in 2,319 blissful pages of Dodd-Frank, the SEC won the prize, and we got 100 mandated rulemakings. And my personal take, when the Volcker rule was finished last December, almost everybody said, okay, it's done. Dodd-Frank is done. We have 57 rules left to write under Dodd-Frank. That's 5 to 10 years worth of rules at a rapid pace. It's impossible. All this nonsense from the Hill, get the rule done. Everyone wants their little pet project done before they're out of power, or the regime change, administration change, and all this pressure. We're moving slowly. And we're not moving slowly. We're moving deliberatively. The asks were simply too great. It was crazy to think you could do 100 rules in a year or two. Just absolutely crazy. And so we're at the point, and I'm confident now that we're taking a look at what we've been neglecting for the last 4 years, why we've had the blinders on and have been proceeding down the Dodd-Frank death march. And you see things like talk of improvements in our fixed income markets, an equity market structure review, the disclosure review that's happening in the Division of Corporation Finance. These are proactive, organic endeavors that the Commission, the staff are taking up, which are vitally important to the agency and the markets and market participants we oversee. We can't let these programs atrophy, right? We're talking about Reg D and other areas. We need to keep working on them. So I am mildly optimistic that we can take up new endeavors. Creating a new office with a new function is about as easy as anything we could do. But we'll see. Jury's out. We'll see what the reaction is when we get back. Got it right in front of you.
Hi, Jillian Flores from Porterfield and Lowenthal. I have a fear that despite all of the progress we made in the Jobs Act on Reg D in particular, the future of the accredited investor definition could hamper a lot of that. Could you share your views on what you expect to happen?
You're just talking about the future of further reining in the definition of accredited investor. A lot of people have been talking about that in the study.
Changing the metrics,
right.
And I know we've talked before about changing the metrics for the better, but I think a lot of people fear that's not what would happen.
Yeah, that's a patient you don't necessarily want on the table right now, I would say, because the trend in things is not to make them better the last few years. So, just stay off to the side and hide and hope for the cavalry. Yeah. So, I don't think anything is imminent. There's been a lot of rhetoric, other commissioners talking about the need to look at it. I mean, again, I would agree in the sense that if we can make it better, we should. I don't think that's the intent right now. Dodd-Frank obviously made a material change to the definition by removing your primary residence. I think that should be something we study for a little while and understand the impact of that before we take action. And so I don't believe it's a front burner item right now. I don't believe it should be. We've bitten off a lot, and we're having a hard time chewing right now and all across the board. And there are things that are much more important than that. But at the same time, I think that there are certain special interest groups weighing in on that issue that get a heck of a lot more attention than mature American groups or small business groups. If the last rulemaking that we had on NRSROs was any example, sometimes they win out in the agenda. So we'll see. Got to go. Oh, so one more question, I guess.
Commissioner, thank you for your comments today. Chris Tyrrell from the Offer Board Group and the crowdfunding industry trade group, CIFRA. The gentleman earlier alluded to the lack of data about how these things are or will affect the economy. First, I wanted to offer to you the data that the Offer Board Group has compiled on what's happened since the release of 506C and Title II of the Jobs Act. We've been looking by industry and by geography, and there are some very interesting shifts.
Okay.
We're going to release a series of white papers over the next few months by industry explaining what we see in the data. But my question is, I had a conversation with Craig Lewis after he left, and he said that when he was chief economist of the SEC, they went looking for data to justify the claim that these kinds of changes in financial laws actually do have an impact on the economy in specific ways, and when wasn't able to find them. Do you know if the SEC intends to pursue vigorously additional data creation and collection efforts to really bring in the data that will allow us to make these
Right.
great claims,
Right.
and we think we see
Right.
anecdotal evidence of it everywhere, but supported by data?
So I don't know the answer to the discrete question with respect to private offerings, crowdfunding specifically. As a general matter, the answer should be yes. We should be seeking it out. I think Craig Lewis, I can't give him enough credit for creating a real economics function at the SEC. I know a lot of you, probably rightfully for years, have been critical about the role of economists at the commission. There haven't been enough of them. Their voice hasn't been heard. It has been, rulemakings devoid of economic analysis. Craig was revolutionary in changing that. We have a full division now, the newest division in the agency, devoted, DERA, the Division of Economic and Risk Analysis. We've gotten a number of really high-end PhD economists in because it's now becoming an attractive place to come, in part because we have access to a lot of data, and they want to do research. Right? If you look at what the Fed does, right, they're almost all free agent economists with access to tons of data. They're able to publish, and that's why folks come there. They want to have access to that data. We still got a ways to go, but Craig did a really good job in liberalizing the restrictions on the use of data, publication of academic papers and the like. So, we did have the Reg D paper despite its limitations last year. We have the ability, certainly the personnel on board to do this, but marrying it all up and getting it out for reaction to prove out these points that you're talking about, that's the next step, doing that on a regular basis. And I'm hoping our new chief economist will follow Craig's lead here and institutionalize that, and you'll see more and more. Thanks very much, everyone. I appreciate you having me.
Thank you all for coming. We're done for today.